Hello and welcome back to another episode of Fun Friday with my guest here. But before we do an introduction on the guest, I don't ever really do this, but I'm going to start to move forward. We do have a call to action finally to start this episode. As you've heard on the flagship station here, the Lone Star Capital podcast, we are hosting our summit, our New York City summit event that we're super excited about. That'll be on September 14th and 15th in New York City, bringing the best and brightest of our network together as well as the industry. We're going to have top-end sponsors, institutional equity players, family offices, high-net-worth individuals, and fund-to-fund managers all in one ecosystem, plus vendors and lenders and so on and so forth, all together in one room to bring together the best, most hand-selected, curated environment possible. This is by application and invitation only. We're really gatekeeping this room. We have a limited number of tickets. We've done this event now 5 times, but we know that this is going to be the best iteration of it yet. I'm actually highly confident in that. And I don't just like throwing that stuff around. Like I take very much so pride in the events that we do. I have an insight to this. This is kind of my baby right now. So we are very excited for the New York City Summit coming up September 14th and 15th. If you'd like to learn more information about that, please reach out to myself, Craig, C-R-A-I-G, at lscre.com. You can also go to our website and I think it's just literally Lone Star Capital Summit. In any event, it's on our website. Go to the About Us page and it'll come there. But without further ado, I want to welcome our very special guest today, the founder of Grow Your Cashflow, Pascal Wagner. How are you today, my friend?
Hey, Craig. Thanks for having me.
Yeah, awesome to have you on today. Super excited. And Pascal, we got really, I believe, initially acquainted at the Best Ever Conference, which I'm not mistaken, you, just to give you a quick shout out to start, are now on their podcast network. Is that correct?
Yes, I gave a workshop, and I also am now one of the new rotating Thursday host oriented towards helping LPs become better investors.
Gotcha. So you have a show solely predicated, I'm hearing then, on working on the most important thing, the straw that stirs the drink, which is investors and the limited partner passive investors. Is that correct?
That's exactly right. Yep.
Awesome. And before we get into this show, what is that show kind of geared towards? Is that just basically best practices in the business with operators, with basically fund managers, with other successful LPs? Like, what is like the mission behind that, would you say?
Yeah. So I would say what I'm doing is I am serving the LP by having 3 different types of episodes. So from my perspective, I'm an LP and I'm selfishly trying to learn and become better and use this platform as a way to help the listeners. And I think of that in 3 different ways. The first is, let's interview other successful LPs. Let's hear their story. Why did they get into it? What was the problem they were trying to solve? What mistakes did they make? What do they wish, what do they wish they could do better? The second is we interview different operators. So we actually just talked, we're having Lone Star Capital on the show, but understanding, what makes an operator unique? How do they think? What are some maybe unique insights to their asset class or how they think about their asset class? And then the third is talking to vendors. So if you're a bookkeeper or you're a fund attorney or basically anyone that deals with many different operators, kind of have that third party perspective of what do the best of the best operators do and what do the not so good operators do, because they've likely served 100, 500, in some cases over 1,000 different syndicators and can see trends across these across the different operators. And so taking all of those different perspectives to help the LP make better decisions.
Yeah, and I'm really excited to talk to you today because I think what you're, Pascal, looking to solve for is something that I think is really well said shortly in one sentence, if you will, which is I'm looking to solve for creating $100,000 a year in passive income, basically generating 6 figures in passive income, and how to do that. I think that's very topical. I think now the American dream may not be particularly for millennials. I'm a millennial. I believe you are as well, I would assume. And Gen Z is not to have the fat house. I mean, yeah, it'd be nice to have a big house and whatnot, but it's really actually to live a really high quality lifestyle, which is locational freedom, time freedom, the ability to have a more enhanced life, maybe with more amenities. And how you do that might not be burdened by a massive mortgage, having a bunch of liabilities, but actually the other end of that coin, which is, generating large sums of passive income. And, the goal is basically, as you mentioned, and I'll let you kind of summarize it best with the full mission statement, but is basically around getting six-figure passive income going. So how would you kind of describe that, or did I do an okay job?
Yeah, no, I think you nailed it, right? I think um, what I'm essentially doing is, I had a life event where I had to figure out how to invest passively and generate cash flow, and no one sits down and teaches you how to be a professional LP investor. No one, everyone says their asset class is the best thing since sliced bread. Everyone, their pitch decks all look great, the IRRs look good, but it's really hard to figure out, who do you trust, what questions do you ask, what documents are you allowed to ask for, and if the operator doesn't give it to you, that's a red flag. It's really oriented around, I've done 23 LP investments so far. I've invested over $3 million across LP investments, and I also have done over $150 million of investing through my last career in venture capital. And so there's so much that I wish I knew when I started, and my mission is to help people avoid those mistakes.
Yeah, that's really well said. And I get very passionate thinking about this because it's really ultimately what we're all looking to do here. Whether it be with every career path you take, personally, mine was, hey, I was selling homes. And if you're selling homes, you buy homes, and you buy homes and they give you cash flow. They give you cash flow. You get to do what you want to do. Well, now what I'm doing now is, instead of buying homes, I'm investing in Lone Star syndications, and I might buy a house here and there, right? Just like you may as well. Like many of the listeners, right? There's more than one way to make a buck. You have the equity lifts there, but it's really to figure out a system and a structure in which you are getting consistent, reliable, recession-proof cash flow as much as possible, right? If that's not almost an oxymoron there, if you will, which is recession-proof, consistent cash flow. But nevertheless, there are ways to identify good opportunities, bad opportunities. There's ways to play this game, and what gets me excited is basically educating the investor the right way to do it. And there's so many ways to mess it up. There's so many ways to get it right. So helping people navigate that process, particularly when they're young, is super important in their journey of investing. And quite frankly, some of the best operators actually have the worst marketing materials. They might honestly come off as perhaps slightly aloof because they don't need your money. And the worst operators might have one thing down, which is sales and marketing, and be super friendly. They might be very gregarious like you or myself. That might be very exciting, but they might be terrible operators. Of course, we're not a terrible operator. You're not a terrible investor. But the point goes saying there is, navigating that process is not easy. So you basically now are making your life missions through that, which is super admirable. So let's kind of get into that story, right? So you kind of had the money, started investing. I guess in that journey, where are you right now?
Yeah. Where am I now? I mean, I think my big focus right now has been going deeper in the space. I'm at a position where we have around like $250,000 in cash flow coming in a year from our investments. And, um, I think when I started down this path, I eventually landed into the world of debt funds as like one of the key pillars of generating consistent cash flow for us.
And what year did you get into the debt funds, if you don't mind me asking? Sorry to cut you off.
Yeah, I think 2022. And
That's that's by the way, it's really smart of you to get into it then, because I don't think it's a little known secret right now that those who maybe invested in the first half of 22, and particularly those in 21, are experiencing extreme distress. So to have navigated that correctly on the front end, but to choose the debt route, which maybe doesn't have as the highest return as those sexy, multifamily deals, but have the cash flow perspective. What a long and short position there.
yeah, I mean, I think, I was just talking about how much macroeconomics plays into what should play into your investment thesis, right? Like if interest rates are at all-time lows, and the largest determining factor of real estate valuations is what the interest rates are. Investing when it's at all-time lows, it's this fascinating dynamic because you can get buildings for so cheap, and you feel like you're winning by getting this low interest rate. But the only place that interest rates could go was up in that time period. Um, and I didn't stop investing in multifamily, but it definitely shifted a lot of what I invested in because of that. And I think it's different today, right?
Absolutely. And how would you say, just from a perspective, because you mentioned venture capital before this, how would you say the venture capital world kind of helped you become the investor you are today?
I love
Because
this
that's the
question.
opposite. Because that's an opposite world as well. That's like very much so either you're striking out swinging and gloriously, or you're hitting a grand slam sometimes, right?
Yeah. There are a couple different things, nuances, things I learned, and differences that I can talk about. So, I think maybe I'll just dive into like the story and give you like a deeper picture. So, um, my role, I was brought in as a basically fund and portfolio manager into the 5-person investment team out of the 300-person company at Techstars that specifically was in charge of managing um, a $150 million fund that Techstars had just raised. And the purpose of that fund was to invest in the follow-on. Basically, Techstars is a 3-month accelerator where they will give a company their first $150,000 check, and they come into your office, and then they get mentored for 3 months. And then, we introduce them to other VCs and push them out the door and say, good luck. And the follow-on fund that I was brought in to help with, we were trying to pick the top performers of the 2,500 companies Techstars had already funded. And, I think the biggest thing that shaped my how I invest was understanding how these institutions invest. So, I had a boss. He was the chief investment officer at Techstars, and they had a strategy. And I really got to see firsthand how, a fund or a fund manager needs to basically state and create a pitch deck around what it is they're going to do. In our case, it was like, we're going to raise a $150 million fund. We're going to invest in the top 10, 20% of portfolio companies. And we're going to be able to determine that by X, Y, and Z. And we will only invest in deals that raise a minimum of $750K. We're never going to be the lead investor. We're never going to be the largest check. There were all these rules. And then my role was to go and figure out all of the companies within the portfolio that we're raising, apply that investment thesis, and basically try and figure out how to evaluate 2,500 companies growing every single year at scale quickly. And what that required me to do was to basically create, like a if then tree, right? Hey, if I'm only looking for companies within our portfolio that match these things, and then we would see hundreds, thousands of deals come through, and I would easily, very quickly filter yes or no. And that filter blocks out 80% of the companies. And so now you can spend more time evaluating and looking at the top 20% and figuring out what you want to invest into. And I think that is a huge piece that I think most investors, if you're new to this niche, they don't do. And frankly, before I learned how they did it, I never thought of stocks that way either, right? But it all starts with, what is the thesis? I believe that multifamily is going to be big over the next 10 years. When I think about Lone Star, over the next 10 years, we think that it's going to be difficult to do like heavy value adds and stuff like that in this market. So we're going to focus on a tax abatement strategy and focus on lowering the expenses. And that is your thesis, right? So then now let's go and figure out who are all the companies, all the operators who fit within that bucket, and then look at their deals, right? It's a very different way of looking at it than how an investor might get a deal in their inbox, every week or every month, and then try and figure out, like, is this a good deal or not?
That's a really awesome way to do it. And although it's probably very time intensive, it's probably also, though, similarly a massive time saver. Because if you can identify what you want there from, your thesis, like as we mentioned, we spoke about, we think it might be very difficult to do value add deals. Okay, then you only look at the deals that fit X box, and then you can basically disregard everything else or every other sponsor, right? And then you can say, okay, well, I'll look for these multifamily deals because I still think multifamily is a good investment. But then I can put my other dollars in a different bucket, which would be the debt funds and stuff like that, right? So basically, once you eliminate deals, then you can actually look at deals. Is that kind of how you looked at it to a spectrum?
Yeah. I mean, uh, I have so many people that come through my programs that basically say, they bring me a deal and they're like, "Hey, Pascal, like, what do you think about this?" And the first question I ask them is like, "How does this fit into your broader plan?" And and I think the thing that I did, and that I think is like normal for someone new to this industry, is you don't have the context to understand what a good deal is. When I first started working at Techstars and I was looking at these companies that were coming across my desk, I am very much the person who's like looking at this deal, and they're all projecting that they're going to become billion-dollar companies. That's the whole point of taking venture-backed money, right? And for the first several months, you're like, wow, every single deal I'm looking at, they all look like
Grand
deals
slams.
I would want to put money, yeah, totally,
Yeah.
put money into. And then, you know, after year 2 or year 3, now I've seen over 2,000 deals, and it's much easier for me to identify what's average and what are the outliers, because I've seen so many deals. You can't do that if you only have looked at 5 deals or 20 deals, across 10 different asset classes.
Yeah, no, that's really well stated and very humble of you to admit that and use those analogies as well. And so you basically took that venture capital mindset into this kind of other alt world, which is kind of, the multifamily, the debt funds, the syndication space. Is that correct? And is that why you basically started in the debt world, just because you thought it was the best kind of risk adjusted return considering the marketplace, or?
No, it's so funny. And I say it's funny, but I think when I first got into LP investing, my original thesis was I want to invest with institutional operators. I don't want to, unlike venture capital, where the experience doesn't matter. It's really about the the opportunity and how fast they're growing. Whereas in real estate, it's totally the opposite, right? Like, I want to work with people who've been through multiple downturns. There's no chance if they crush it that they're going to become a unicorn, a billion-dollar company. I mean, there's a range of outcomes that's possible in these real estate assets, right? So I very much was looking for experience. That was my thesis. I didn't have the I think when I was looking at the deals, I didn't appreciate. I mean, first off, there are so many terms and things you need to learn. Like, preferred return doesn't actually mean that you get the money of what the preferred. If it says 8% preferred return, that basically just means you get the first 8%.
Yeah,
It's
not an
not.
eight coupon.
Yeah. And I think it's easy to conflate things like that. And I also it was after my first several investments. So, first I invested with Reliant Self Storage. It's a huge institutional self storage firm. I invested with Grant Cardone. He has tons of he's institutional quality, and he was buying things here in Miami that I thought were great assets and that I thought would grow. And that was where my thesis was. It was really later when I learned this concept of the money pie from the real estate radio guys that I really started changing how I thought about investing. And this money pie concept is like you can invest for one of three things. You can invest for cash flow, you can invest for equity growth, or you can invest to reduce your taxable income or depreciation. And it's in a pie format. So, if you go for all cash flow, you should be able to get more cash flow than a deal where you're trying to maybe get all three. And so it was just very eye opening, and that's what really shifted me to then think about like, okay, what is designed to where the primary purpose was to provide cash flow. And so I think that's, it made it also much easier to identify what was going to work over the next 5 or so years, right? Like if what did the fund distribute last month and a year ago and 5 years ago? Oh, it's been consistent, great. Like looks, versus when you go into an equity deal, it's much harder to predict.
It's very unpredictable because so much of it is based around, how did the manager manage everything? Was there, no weather issues, particularly if you're in Florida or in Houston or on the Gulf or the Carolinas? How do you know that's going to come up? Are the interest rates going to go from ZERP to 4% on SOFR plus? What is going to happen there? So you're right. It is substantially less predictable. You could be missing out on some of the upside, but you also are going to protect your downside substantially with the cash flow, right?
Yeah, there's trade-offs. Yeah, I think it's just every investor has a different way that they play the game and a different strategy, and mine has been I have a portion of assets that do a mixture of all three. I have a portfolio of homes in Atlanta that I rent by the room, and then I have my credit funds that provide me consistent cash flow, and then I have things that are just in equities, right? Like the stock market, where the only goal is equity growth. And so, for me, thinking about it that way, I feel like I can be a lot more aggressive with my equity investments because I have the consistency in some other parts.
Yeah, and I think that's one of the big takeaways for all the listeners here to think about is, okay, if you get a borderline or not a borderline, but a base foundation of hitting X dollars a month, whatever your nut is, whatever your number is, it could be $100,000 right on passives, right? If you can kind of create a situation where you can have that consistent, reliable cash flow coming in of that figure, and then every additional investment after that doesn't have to be in that same bucket. It could go in that bucket, but you could start thinking about a multifamily investment. You could think about S&P 500. You could think about Bitcoin. You could think about whatever the heck you'd like to do, right? But just getting that baseline foundation there is kind of the start to get riskier and to really see kind of your capital appreciate in a different manner. So that's one takeaway I want everyone to be thinking about is that right there. So now that, I guess let's go transition. This all kind of similar there, if you will, is when you speak to your clients there, right? Because you do coaching, you do kind of mentorship there. What are some of the questions that they have? What are FAQs and what are kind of some of the things that you let them know as to how to kind of avoid pitfalls there and where to allocate their dollars? I'm sure it's pretty personalized, but.
Yeah. When I started, I would just allow people to ask me questions. And then slowly over time, I realized there were like a couple core things that were the same repeat questions over and over. So I can tell you that there's 3 core pieces that we go through in the program that cover the 3 common areas. The first is having a plan. Like, okay, what is your actual goal? Are you trying to reach 6 figures in passive income, or are you trying to grow your net worth? Like, a lot of people come to me with deals and they do a little bit of all 3, and it just kind of looks like a good deal, but it doesn't help, there's not enough cash flow on it, and they don't really need the cash flow now, and you know the return is not oriented around being the highest return thing. So they're kind of in this like no man's land of what are they trying to do with this deal? How does that fit into their portfolio? So a lot of it is figuring out where do you want to go and working backwards from that. And then like, okay, you want 6 figures in passive income. Is that $1 million into 4 different deals at $250K each that, 2 of the funds generate 8% and 2 of the funds generate 12%? And that's how you make it to your, or is it you're taking 20 investments at 50K each, and some of them deliver 6%, and some of them are crushing it, and and it's like, let's just look at what it would look like, and figure out, are we comfortable with that? Do we want to be investing in a bunch of funds, or do we want to invest in syndications? Do we need monthly distributions or quarterly distributions? Do I want to be investing in debt or equity in this market cycle, or in this part of my portfolio? And so thinking through a lot of those pieces, because that's really the foundation before you can look or figure out if a deal makes sense. The second part is then, the common question that comes up is, can you take a look at this deal? Is this a good deal? And like, let's say, it's we've done all the pre-work and we figured out like we want to be in multifamily. We want at least quarterly distributions. I want it to be a 5-year timeline or less, or whatever the criteria is.
Not a development play, but
Not right. Like we like the strategy of value add, not development. Right. But then it goes back to what we talked about, is they're like, but tell me, is this a good deal? And it's like, okay, I'm not going to be the guru here, that's going to sprinkle magic fairy dust and say like, this is going to be a winner. What I can do is we can pull up a bunch of other deals that are like this one, and let's compare them all. Like I said, context is what matters, right? Like these other deals, even maybe open deals that they could invest to, like, why is it this one that you like over these 5 others? Like, why do you like Lone Star Capital over, Joe Schmo Operator? Like, what are the reasons? Let's talk about them. Let's like make sure we understand the differences there. And then the third piece that we do is, the big question that comes up is like, how do I do due diligence? Like, I just want to become better at due diligence. I want to know what questions to ask. Can you help me? And so, what I do there is, I'm not someone here that's saying this is how to do it. What I do is I show them my framework for how we look at deals. So for me, what I do is I have a 100-point checklist where, there's 10 questions around the operator. There's 10 questions like, what's the story of the deal? Like, do I know other people investing in it? How many deals have gone full cycle? What are the debt terms? Like, let's go how many of their investors are repeat investors? How, and it's about, how do I rigorously ask the same questions for every deal that I go through to make sure I don't miss anything? So when you're listening to podcasts and you hear that anecdote of like, oh, I need, that was a good question, I'm going to make sure that, I write that down. You're adding that to your checklist, and that goes into your framework to make sure you know what you're asking for every time. And half of it is like, how do you teach someone to trust but verify? It's like, okay, if you're investing in a debt fund, I want to see a loan tape. I want to see all the loans that company has, and if they're not willing to show that to me, that's a red flag. And I share those kind of expectations. there are plenty of other funds that will show you the loan tape, and the how transparent the operator is today is going to be the most transparent they will ever be. Versus 5 years down the line when they have your money and there's, they have the control. So it's a lot about giving people the frameworks they need to feel more confident, because that's what they're looking for. They're looking for confidence. They're looking for, is this the right deal? How do I evaluate this? And it's through having a system.
Yeah, and I think the space right now, although some have been in it for longer than others, it still feels really new. And I feel like the beautiful thing about the space, it's like one of those like fastest growing things where there's still new people pouring in all the time. They want to get in syndication. There's new people that are looking for kind of multiple sources. And really up until recently, the stock market's really been humming, but the stock market's not always humming. Today, when we're recording, the market was down quite significantly. And it's kind of when that occurs, the stability of these alts, these illiquid investments really get popular again. And they might not be as in vogue right now today because the stock market is so high, because treasuries are at where they're at right now. But rest assured, that will change at some point, and people kind of start flooding back into this space. So just realize that these questions are going to keep coming up, and more people will be getting into this, and navigating this kind of field is just such an important one. With that said, I know let's just shift to here to the debt side of things. Are you in debt funds that have, certain liquidity lockups? Because I imagine as the world is changing right now, as the multifamily world is shifting right now, as you get more educated, as you get more context, some of my thoughts are going to be, well, I can almost feel that if interest rates are going down and whatnot, I would have to imagine the yields are going to start going down as well on debt funds. So are you starting to, I guess, are you in, I guess, two-part question. Are you in debt funds that give you pretty good liquidity? And are you starting to kind of ramp up your multifamily education so you can kind of get the bi-prong dual moat of, appreciation and cash flow?
Yeah, so I'm in a bunch of different funds. I'm in the DLP lending fund. I'm in the DLP preferred credit fund. I provide transactional funding to a wholesaler. I'm in a cannabis mortgage debt fund called Polaris Fund. There's each fund has their pros and cons and their the way that they run, right? For example, the DLP funds have a 90-day liquidity period legally, so I can ask for my money back, and in practice, as of right now, as I've recently heard, it's you get your money back within 3 or 4 weeks, and that's a type of fund where this is actually something that I looked at. You talked about lowering or rising interest rates. The DLP lending fund, for example, has produced double-digit returns for the last decade when interest rates were low and when they were high. So, could there be some shifts, and could it drop between that, or things like that? But those are typically things that I'm looking for when I'm making the investment, because I'm asking myself these downside questions. What happens when interest rates go down? What is the risk to the fund when these interest rates go down? There's other funds I'm in, for example, like the cannabis mortgage fund with Polaris, where, this is actually where I learned a lot of the lesson. I talked about requiring the loan tape before. Had I waited and looked for the next loan tape that came out before I made my investment, I would have realized that there was a large jump in non-performing loans, and I didn't see that happen before I invested. And so that is a fund that's still distributing, previously they distributed like 10 to 14% annualized. And now they are producing like 4 to 6%. And they've locked the fund, which is a very real scenario that can happen in any any debt fund or mortgage fund that you're in. So, to prevent a run on the bank, because the fund isn't producing what it used to. It's still producing, but just, not as much. And so, yeah, I have different liquidity across these different things. It's interesting to understand, and firsthand, I've started to learn and realize how valuable it is to have diversification across operators and strategies and vintages and how much that plays a role. And that's why right now I'm really big on continuing to look and find other debt funds so I can just continue to diversify my holdings for the rough ride we're in right now.
Yeah, I mean, that makes a lot of sense. And I really love the fact that, I talk to my friends about this all the time. Like, but if someone just phantom plopped, $1 million in your pocket, you'd be a fool to put that all in one deal. And if you, let's just say you want to put it in one instrument, which is debt, you'd be a fool to put it all in one debt fund. Like, you got to sprinkle that thing around. So I guess the question goes to you. If you had, let's just say, $1 million plop into your account or your client's account, right? What would you say would be the way you'd want to deploy that?
Well, I can tell you this is actually what happened. When my dad passed away in 2001, there was no plan. There was no, my dad handled all the finances, and I had to step up and figure out how to provide my mom a retirement and help her live off the couple $1 million that she had left her. So I literally, I think this is why I'm so passionate about this, because, had I known what I know now, we'd have $1 million more dollars. I think, knowing what I know now, I think the first thing that I would do is I would be investing it across a couple different institutional debt funds. And the reason being is because I will tell you the amount of, first off, like dealing with the stress of, and, grief and of having your dad pass away and, now needing to like move your mom out of where she lived and try and sell the home and, all the crazy stuff that goes along with all of that. But then, trying to figure out how to invest it to generate cash flow and not lose the money, especially because it's a new skill with much larger amounts than I had ever, had to deal with. We'd raised some venture capital money. I'd, experienced moving millions of dollars, but it's just different with different consequences, right? When it's your mom and she's 65 and that's all there's left. So, the reason I would move it into a couple different debt funds is because it removes the pressure of needing to make hasty investment decisions. And you're also in first position of the equity stack, right? So like in terms of the risk profile of investing in different things, debt gets paid first. And so, in most cases, much safer than equity. And so I think that's a great safe haven. And, knowing what I know now, there are plenty of debt funds that generate at least 8 to 12%, which is pretty healthy,
Yeah.
and then you have a foundation, or at least in my mom's case, it was a foundation of cash flow. And, I would have rather than taken chunks, 50K, 100K chunks. And as I came across good deals and saw many different deals, to then cherry pick, take 50 or 100K out of the fund at a time and make an equity investment the right investment. And I think, I'm not a financial advisor. I can't give anyone, advice because I don't know their situation. But man, for me, yeah, that's how I wish I would have done it.
No, I think that's really well said. Is the model is you find your debt funds, you plop out a piece of it here and there when a how could you not deal come up, and quite frankly, they do come up. Now, it's not to say that the deal is guaranteed to do well, but I did instances as well. Actually, the last year where we closed a deal in May of 2024, it was probably one of the cleanest, easiest simple and like most how could you not deal. We've done a Lone Star. I ended up putting a lot of money into it. I sold my house. I put the entire gain and put it in there. So you do get these deals. I'm just saying that because you do get these deals that actually do come up. It's very slow. You got to be patient though, but you have to have conviction to know what to look for and know what a good deal is. And that's by looking at a lot of opportunities.
It's interesting too, because when you think about the strategy in that way, it like, let's say you took the $1 million, you invested it in a set of funds that generate you 10%, you make 100K a year, right? Now you have this kind of like baseline. And if you take 100K out, now you're only making 90K and you're investing it in another deal. And then you can see, does this deal, like, if cash flow is still important to you, as the assumption I'm making, then you can see, is this investment actually panning out how I expected it to? Okay, now I am making 96,000 or 104,000 because we're 3 years into the deal and the value add, generated a lot of return versus, and I understand why people do it. But, versus the traditional approach, I think most people go, which is, I'm investing in an equity deal because I don't need cash right now. But, they don't have a good foundation for what that cash flow is or what it should be, or, is it actually coming in? And frankly, I think equity deals are just much more difficult to analyze than a debt fund, where you can look at what did it produce last month and the year before and the 5 years before that. Trade-offs.
Yeah, it's all about trade-offs. Opportunity cost and investing is super important one to kind of consider and to think about as you are navigating the world. And obviously the world is going into a different place right now, which gets me to my next question, which is, considering all the negative stuff going on, there's going to be a lot of positives as well that comes from this. It's not a secret that when the market cycles change, opportunities do come up. So with that said, what are you looking most forward to in this change in the landscape of the environment here, if you will?
Okay, so what do I think is going to change? I think if you look at the macroeconomic cycle, and if you believe in what the Trump administration is trying to do, which is bring manufacturing onshore and basically, prevent, like, Trump is trying to make the U.S. stronger by making all of our goods and things manufactured here instead of relying on another country, right? If we got into a war with China, the U.S. would spiral in a Great Depression. They take over Taiwan, and all of a sudden we don't have, semiconductor and all the microchips that we need to run all of the technology that we have, right? That's what Trump, in my eyes, is trying to do. And so if you believe that that is what he's trying to do, and you believe that he will be successful in doing that, which, whether you believe it's real or not, saying they're bringing all these companies around the world are pledging to invest in manufacturing in the United States. I think the real question is, okay, how will that affect our investments as LPs? We are, we've seen states like Florida, they just cut their they're in the middle of cutting property taxes, and Mississippi just cut their or maybe it was Louisiana, cut their income tax. And what are they doing? They're trying to make it attractive for all of the manufacturing that is moving towards the United States to draw people in. So where is the manufacturing going to happen? What is going to be, what cities are going to blow up because of the new incentives of bringing all of our manufacturing onshore? What will that do to triple net leases, office space, industrial sector? Like, there's going to be an increase in demand for those things. What will that do to multifamily housing in those areas? If you saw that, Elon was going to move all of his companies to Texas, then being on the front end of that, you would be wanting to invest in all of these different sectors in Texas, right? And so I think it's really thinking about what are they trying to do, and then how will that affect the investments that we're making on the ground. And I will, I think, I mean, everyone. I'm no macro economy person, but if it is true and it does happen, I do think it will be a big boom to, people who invest outside of the stock market, who invest in real assets and real things. And I actually think it's going to be a huge boom for, private investors like Main Street, people doing LP investments, because, I think we're moving away from a time where, Warren Buffett is sitting on record cash levels, 33% of his portfolio is in cash. Ray Dalio has been predicting the end of the debt cycle. The United States has, been we've been funding a lot of the government jobs that have been propping up the economy the last 4 years. If you look at a lot of those big trends and you think about what needs to happen and how that's affecting investments today, I think it's going to be one of the most bullish for at least 4, if not 10 years that we will have in private investments.
Yeah, I mean, I think we're going to experience some temporary pain in some sectors in some places, but I think long term, if we can onshore a lot of important things, that's going to help the country grow significantly. That's jobs. There's a incredible kind of trickle down effect, trickle down economic effect from having a strong middle class, having good jobs that are stable there, building new ones and growing there, not kind of factory A shutting down and factory B people working there as a lateral, but more of a new and improved kind of way for workforce there. Pascal, you've been great. What are you promoting right now? What are you working on? How can people find you?
Yeah, I am. What I'm doing is I provide, all the resources that you need as a new LP investor. So if you're looking for deal flow, I have deal flow that I send to my email list every Friday. I have a deal review session. So if you have a deal you're looking at and want a second opinion, I do those. I have my Cash Flow Academy, where I kind of help people build this big 6-figure passive income portfolio and learn how to look at deals and understand the players in the landscape. So if any of that's interesting to you, I encourage you to opt into our starter kit at passiveinvestingstarterkit.com. You can also go to growyourcashflow.io. But I really appreciate you having me on. This was fun.
Yeah, also Pascal is on the Best Ever podcast channel. What is the name of the podcast?
Yeah, it is the Passive Income Playbook with Pascal on the Best Ever series. So my show comes out every Thursday, would love to have you tune in.
Awesome. And you're in Miami if people want to reach out to you there.
Yes, absolutely. Love taking local meetings. So if you're in downtown Miami, this is my new home, and would love to meet.
See him in Brickell, everyone. For those who are listening, we appreciate you, and we'll see you next week.